Hi, and welcome back to my tax guy, my tax channel to help people understand everyday taxes and how they can best manage it so it's a benefit for themselves and building their future. Today's gonna be a little different than usual. It's Father's Day, and I'm gonna be speaking more off the cuff today than usual. One of the things that I've come across probably in the last couple of days, is just some people with withholding issues. Now, typically, withholding is really done by your employer, but a lot of people have misconceptions about what that actually means. And by this, I mean, what are withholdings actually for? Okay? Withholdings of your paycheck all have a special purpose. Whether you're talking about your federal withholding, Social Security, Medicare, state taxes, local taxes. You even have disability, paid family leave, which kind of speaks for itself, things like that. And the reason why all of those things are in place are really to make sure that some of your bases are covered. What a lot of things people were found to be complaining about, the government tried to fix through taxation because really that's their only recourse to do a lot of things. But a lot of people have a bad understanding or maybe some misconceptions about what they should be doing as far as like getting their withholdings done. And this is just going to be really brief. The first thing I'll tell you is your refund is based on your taxes being paid. There's no two ways about it. Anyone who tells you anything different, I don't know what they're telling you. There are certain credits which are refundable, and for the most part, under certain income guidelines, those credits are available to you. For instance, earned income credit maxes out at around $52,000. The maximum amount you can get is $6,000, give or take. I think it's about $59.90. And you get that for your three kids. So under 52K, you're usually in good shape with three kids. If you're married, then it's like 58K. Same three kids. The amount doesn't really change. But here's where the issues come in. Once that's said and done, once you're out of the range of earned income credit, people usually still think that they can kind of like skimp on the withholdings, and you cannot. You're going to create a tax bill for yourself, and to be perfectly frank with you, most people don't want bills after they already have the withholding done. So the best thing for you to do, honestly, is to make sure that your withholding is being done in a way that covers you. All right. Everybody wants a refund. I get it. No one wants to work the whole year and then be told, well, you're not really getting a refund, or your refund is only going to be like $100 or whatever the case is. But here's the problem. That kind of thinking lends itself to people going, well, I'll take all my money now. Well, you can do that. You are entitled to take your money now. But you have to understand taxes is a money now or money later situation because you're going to pay them one way or the other. You're either going to pay them as in your paycheck as they're taking out the money, or you're going to pay it at the end of the year because you've been saving and you have an idea of what your tax bill is, what your tax bill is going to look like. But either way, you're going to be paying taxes. Now, I usually suggest for people who don't fall under the self-employment, independent contractor, entrepreneur, I suggest to those people that they pay estimated taxes because they don't really have withholding. It works a little bit differently for them than it does for people who actually have employers. But for people who have employers, let your employer do what he needs to do. Because a lot of the time, when you get that bill at the end of a tax session, your preparer can't foresee you not paying your taxes through the year. If you had to prepare for a couple of years and he's really good and really well sourced, knows what he's talking about or she's talking about, always trying to give you advice before you walk out the door, always saying, hey, this is how we can do it better for next year. Here's some programs where you can defer some taxes outside of your job and it'll help you, or some things you could put money in that'll actually be a write-off for you that you can take full advantage of without the limitations of like things like AGI or Schedule A or things like that, because all those different forms have limitations. And I'll give you an example. For instance, for your Schedule A to kick in and actually be of a benefit for you, each one of those sections has their own guidelines. And the grand total at the end of the Schedule A has to be greater than the standard deduction for it to even help you. So that means that your Schedule A, let's say you're writing off stuff. Your head of household and your standard deduction is $18,600. The total of your Schedule A, the entire sheet, has to be greater than $18,600 for it to be a benefit to you. And if it doesn't come to $18,600, it doesn't do you anything. That's charitable contributions, mortgage interest, state and local taxes that you've paid, causality, and some other miscellaneous deductions. Now, there are certain deductions that people, investment-wise, they used to be able to take deductions on, but they can't take those deductions anymore. Those are what is called, commonly known as Section 212 deductions, which are like investment expenses, brokerage fees, portfolio fees, fees for investment, basically for the whatever firm you're giving the money. Part of that money when you're investing goes to them, and you can't write off what they get. And the main reason why you can't write off what they're getting is because when they include it in their income, the way it's paid to them, they're gonna get taxed on it. So you can't, because if you pay the tax on it and you writing it off, they're not gonna get it. But it's a whole thing with Section 212. I don't want to get into that. Just know those expenses when you pay in the brokerage house and everything like that, it's not for you. So now you're looking at your paycheck and you're saying to yourself, well, I've heard 10% is usually good. And I will tell you that the 10% thing for withholding for the federal usually works up to a certain point. And I will tell you that point is right around $40,000. After $40,000, and whether you have dependents or not, right around $40,000, you're going to start seeing a difference. Because what tends to happen at $40,000, there's no money there. A lot of people like, okay, well, I made $43,000 and I paid $4,300 in taxes. How come I'm only getting a $200 refund? Or how come I'm only getting $700, $800? Depending on your filing status and things like that. So you're getting smaller refunds and you're just wondering why. The reason why is because tax tables don't work on like those general concepts. That's not really how they work. Okay? But you need to just make sure, the number one thing is to make sure that your taxes are coming out correctly. You're setting yourself up to fail. That at the end of a year where you've already had, and I'll give you an example because this happened literally the other day. I had someone in there. The person came in, they made $70,000 and they only paid $3,000 in taxes and was wondering why they owed. And I had to explain to them like, hey, you have to pay. I thought $3,000 was fine. No, it's not fine. $3,000 is fine if you're making $33,000. That's when it's fine. But when you're talking about $70,000, you can't be paying taxes like you're making $33,000 and you have $70,000. It doesn't work. And unfortunately, and I want to be honest about this, a lot of people still think it really doesn't matter what they pay. They still expect for the tax preparer to work some sort of miracle for them and to squeeze every juice out of the jug and make sure they never have to pay no matter what their tax burden is. And that's not the way that works. Your preparer, if they're well versed in tax law, or at least have a very good basic underlying understanding of how taxes actually work, can really only do so much when you do that. You kind of tying their hands behind their back and telling them to make a miracle happen. And they can't do it. The most important thing also when you're doing your taxes is really to be reviewing your pay stubs from period to period. It doesn't really matter if you want to do it every 2 to 3 months, if you want to do it every week, if you want to literally do it every day. Some people are really love doing it every day. They're obsessed over it. So they're like, okay, well, I need to make sure, and I think it's supposed to be this. And so at the end of the week, this is what I'm expecting to come out of my paycheck. Some people are like that. No matter which one of those groups you fall in, you want to make sure that you just have it so that you're looking at it and you're comparing it to things like last year. What were your issues at the end of 12 months? Extrapolate it out. Start taking 5 to 10 minutes and really look at your pay stub. Because a lot of the times, if the withholding issues that you tend to have at the end of your year, you can probably fix them usually by the end of whatever tax season you're in. I usually advise my clients, especially the ones who don't have kids, do not worry about things like putting down your dependents and stuff like that. Because as you earn more money, that stuff goes away. Okay, I'll give you a perfect example. I had a client. One year she made $26,000, and literally the next year she had $51,000. Now she has 4 kids, so of course still gets earned income credit. She's okay with all of that. But what she didn't understand is that out of that $51,000 that she was making, she had about $6,000 of what's called capital gain from her investment income. So guess what happened to her earned income credit? It went away. And when her earned income credit went away, she found out very quickly that she did not pay enough taxes. Because what she thought she paid, she wasn't paying. So at $51,000, she really thought that $1,100 would be enough. And when she saw her refund, she was confused. And I said, hey, you have to understand, when you have investment income like that and it exceeds a certain dollar amount, Joe Biden gave, a temporary increase for this year. But when it hits a certain dollar amount, that credit goes away. You don't get the earned income credit. It literally is gone. You're not entitled to it anymore. So you have to think along those lines as far as like what would happen if I no longer get these things and I have to make do with what's there. That's why doing your withholding properly is important. It's always better to have a thing in place. If someone's already doing the job, let them do it. As long as at the end of the year you're not going, I have to write checks, and someone's withholding, you make sure that it's done right. Now, the last thing I also want to get into, also about your your paychecks and like pay stubs and withholding and stuff like that, is the thing where a lot of people still want to just take the money and they're not looking at it as, they're not looking at their paychecks as actual paychecks, and they kind of make excuses as to why they can't do certain things. I sat down, sorry, my nose is really itching today, bad allergies. I sat down with my client for a consult. He wanted to know what was going on from a prior year, and we sat down, we really looked over his pay stubs, and we really were talking about his finances and stuff like that. And one of the things he was talking about to me is, well, I always think I should get a refund. I don't think that I should be paying, either I end up paying a federal or a state every year. So I said, hey, well, your number one issue is your withholding. But your second issue, and I'm going to be quite frank to you, is the things that you send your money out to and give away are not helping you tax-wise. And when you fall into a financial issue, the things you're giving your money away for aren't helping you get out of whatever tax situation you're in. And one of the things he told me is he sends money back home. For my brothers and sisters out there, sending money back home basically means he gets here, sends his money to maybe Africa, could be in the Caribbean, could be South America. I'm not going to tell you where he's from. It could be Canada, it could be someplace in Europe, but he's sending money back home for his family. And he says, well, they need it. And I said, well, do they have the same kind of issues you do? And he says, well, what do you mean? I said, hey, when they're working at the end of the year, Do they have the same kind of issues? No, they're usually good, whatever they're doing. I said, okay, so if they're usually good and you're not usually good and you keep having this issue, what do you think the problem is? You're doing so much on your end to make sure you have so much money in your pocket to keep sending back. But every year during the year, you end up with the bill that you keep saying that you don't want. So what is your solution for that? I know what the solution is, but what do you think your solution is? He says, well, maybe I shouldn't send as much money and I should start paying my taxes properly. I said, okay, so that's the solution. But then he says, well, I don't want to do that. And then I said to him, well, I don't know what else we can do as far as getting you like better refunds and things like that. You don't want to do the tax deferred programs. You don't want to participate with any of that stuff at your job. Also, you don't want to put money to the side into other sort of like pro things that you can get actual write-offs on, as opposed to you literally just taking the money out of your pocket and just sending it away. So you're sending the money away that you're supposed to be using for your taxes. And instead of having that money, you now get a bill every year. But then he asked me to look over everything with his and his wife's W-2. So I looked everything over. He says to me, I pay every month. How much was rent? Every month rent is $1,300. So, okay. Now, I want you to understand something. The combined income is around $74,000. Once you account for everything that him and his wife pays in taxes, his wife paid about a grand total between federal, state, Medicare, and all that other stuff. She paid around $6,000. For him, he paid right around $11,000. So you're talking about $17,000. You have to remove that now. Say you take the $17,000 out. You now have to remove that. You now are left with $59,000. He says, I have to pay my rent and my utilities. So I said, okay, we're gonna go bonkers with this stuff. I'm going to tell you how I know what's going on. So he said, okay, we're down to $59,000. You're all with me. Went from $59,000. We then said your rent is $15,600. Okay, so from now we're down to $43,400. We said, oh my God, what about my cable, my light, my gas? I said, okay. Let's say you have the best internet package from Verizon. That's about $200. That's $2,400. You have your light and your gas, $400 a month for each. Okay? Mind you, still at $43,600. So let's say each one of those is 90. Let's say each one of those at the end of the year, $4,800. So $4,800, $9,600. Right? Then we're going to take the $9,600. We're going to tack another $2,400, $12,000. Okay, so we're going to take now. We say $12,000. We remove $12,000. We're now at $31,600. Okay, you and your wife have to buy Metro cards every year. Let's say you guys get the unlimited. Let's be generous. Maybe from time to time you have $12,000. Sorry. You guys, let's say it's $2,000 each. That's another $4,000. Okay. So now you're down to $27,600. You see what's happening? So we're now down to $27,600. Groceries. It's just the two of them. No kids in the house. Let's be extravagant. Let's say your wife, PJs every month. Maybe Costco, things like that. The big grocery chains, Walmart. Let's say she's spending $500 a month on groceries for two people. I know it sounds like a lot because it is $500 a month, even with the recession, the light recession we have going on, because we haven't hit the worst parts of it yet. And let's just say it's 500. Okay. We haven't hit the worst parts of the recession, but let's say it's $500 a month. That's another $6,000. You now take away the $6,000. You're now left with $21,600. I've covered your transportation, food. I did not say anything about if you ever take your wife out to a very nice steak dinner. And I looked at him and I said, so now you are left with the year with $21,000 for the year. I said, that's how, when you say, well, I don't know if I quite have that. Okay, well, you have $21,000 at the end of the year. I took out for your taxes. I took out for your food. We took out for your utilities. We took out for your transportation. He doesn't drive, so it's train. Okay. And he says, well, what if I take an Uber? Well, I bumped up your transportation. So instead of it being at $33, be honest with you, the MetroCard every week will end up being around $1,600. I bumped it up to $200, $2,000, just in case. So I bumped you up. I gave you actually a bump. So I didn't give you the actual number. I literally gave you a bump. So when we're done, and I was very aggressive with giving you very high numbers, usually reserved for families, not usually for single people. Okay. A family of people usually spend about $500 to $1,000 a month on groceries. So I'm giving you $500 a month for two people. It's quite a bit. So I said to him, so what do you think you're doing with the other $21,000? And that's how I had to break it down from a standpoint of what are we doing with our money? And that's really the point of this entire video, where we went past the time I said I would. But it's one of those things where we've got to be realistic about what we're doing with our money and stop making the excuse that we cannot get ourselves together. Because at the end of a year, it is very hard for you to say, hey, I didn't have the money to do this and do that. And then at the same token, you now have all these bills. Because I also told him, let's say you would have saved half of that, you could have easily just wrote the checks out and paid those bills that you currently have for what you owe. But you're not saving any of it. You're sending every dime that you have in your pocket away. And that's not good. And I did this calculation literally based on the taxes that they actually paid. So there are ways that they could have deferred that. They would have done a lot better. But that's not what they did. So that's my timer. So that's letting me know I've exceeded my time. I want to thank everybody for coming in today, and I appreciate it. And I'm looking forward to working with you and getting your feedback and everything like that. Please don't forget to like, share, and subscribe. I really want to make it to 1,000 subscribers by the end of the year. My live stream went crazy on Friday, so I couldn't really do it. So I apologize for that. I'm going to get actually someone to come in and give me a hand getting that set up properly. I really want to go live. I really want to get feedback. And I really just want to answer questions and be able to help folk. So thank you again. I appreciate you, and I hope to see you soon. Have a good one, guys. And also, happy Father's Day. Peace.